Hi, I'm Mike Ward, and I want to talk to you about something we call in finance the investment return puzzle. This is something that I, together with my colleague Chris Muller and our PhD student Pravin Semnarayan, are working on at the moment in South Africa. But it's not a problem unique to South Africa. This is an issue which has been found all over the world and has bothered finance academics and practitioners for a while. So let me take you through what we are going to look at. We teach about investments, that investment is good, capital expenditure is a good thing for companies to do, and it creates jobs. That's the most important thing. What the world needs now is more jobs. And usually CapEx is the place that creates jobs, although I put usually here because these days with robotics, it's not always so true. It also grows the assets of a company, which is a good thing because it ensures there will be a future for that company. Companies that don't invest will eventually just fade away. Now, we do put in some provisos here. It is a good idea to do CapEx, but that CapEx must create value for the providers of capital. And we measure that in ways in which you'll be familiar with metrics such as NPV, EVA, economic value added, and IRR, internal rates of return. And the idea is that these providers of capital must get a positive above what they want return. And so that's why these metrics work. Now, let me show you what we actually expect to find when we do this. On this axis here, I'm showing you what return investors would expect to get against, on the x-axis here, the investment in CapEx as a percentage of assets. And the CapEx we're talking about here is into fixed assets after depreciation, as you'll see just now. So I think you would agree that what we would expect to see is some sort of positive relationship over here. If you don't invest in CapEx over here, returns are certainly in the longer term going to fade away completely. You will lose money. As you find more and more NPV projects, which presumably are going to give you positive returns above what shareholders want, this should be good for shareholders. But that isn't actually what we find. So let me take you through what we do. This is the methodology that we follow. And we start off by moving back in time, and we just, for illustration purposes, we're going to go back 12 years or so. And we're going to take the biggest 160 companies on the JSE. We're going to calculate this ratio of interest to us here, their asset growth, by taking the increase in assets, and these will be fixed assets actually, and divide this by their fixed assets. And we're going to then rank them by the ratio, the asset growth ratio, and we're going to group them into equal weighted quintiles. So we'll have 32 companies in 5 portfolios, with quintile 1 containing those which have invested the most, going all the way down to quintile 5, those that have invested nothing, or in fact little, or even even minus investment here. They're actually shrinking. And once we've done that, we're going to measure the daily performance in terms of total returns here that those companies showed on the stock exchange. What did the share price plus dividends and so on do over the next 3 months? Once we've done that, we're going to start again. We'll move the data 1 quarter up, and we'll be on the 31st of March, say 2004. Look for the top new companies that might have come, re-rank them, having calculated their ratios, and measure the daily returns for the next 3 months. And then we're going to wind this up. Now we're going to show you what we get, and you'll see this kind of graphic is the output of our results. These lines here that you're seeing here represent the daily performance of each of the quintiles. And if you look at the end here, you will notice that this red line here is actually quintile 1, the one with the most investment going into it. And right next to it, in fact, overshadowing it, are quintiles 2 and 3. So we've got a group here, the top 3 quintiles, in fact, all very similar here. They are showing us a return, annualized return over these 12 years or so of about 18% per annum. The 2 portfolios 4 and 5 down here, which were the 2 with the least investment in assets, are giving us a better return of 24%. And this is the issue. This is not what we would expect to find. So just to mention over here, this is the all-share index, our benchmark here. And you'll notice all of our portfolios are above that. That's because we've excluded financial companies and mining companies, which didn't do too well in this particular period here from our sample. And we do that because their assets are different for various reasons. And also our quintiles are equal weighted, whereas this is a market cap weighted. So there may be something of a size effect here, although we don't really think so. So that's what we get. Now, before we get too excited about this though, we want to play around with the data a little bit. And we need to optimize what we refer to as the look-back period, because we know that companies may spend a lot of money over a period of time, and the results of that may take some time to come through. So we want to input a lag into the data here, and we also want to be able to play around with this CapEx period, move it up and down here and see what it looks like. So we're going to focus on quintile 1 to begin with, which is, remember, the one with the most companies investing the most in assets in. And I'm going to show you a grid here, which is really essentially playing with this CapEx period over here. We're going to vary our CapEx starting year from 10 years before the performance period here. So we're going to start this minus 10 years from where we want to measure how well we did. And we're also going to move this end around a bit here, and this is the CapEx year end here. So going from 0 years all the way up to 9 years. So this column, for example, here represents taking this block, starting here, and with just looking back over the last year. In fact, that's what that result there is. If you keep it going here without a lag and you run it for 2 years, you get this point here, and this would take you all the way down here to running back 10 years. If we start introducing a 1 year lag, we then get this result here, and so on. So that every point here gives us a complete mapping of all the options here for varying the investment period and the lag period between we look at how we look at these results. Now we've color coded this to make it a little bit easier for you to follow, and straight away what this is telling us here, the red means bad results, is that investment in the short term, recent investment here, is pretty much all bad. And down here where we're looking at investments further away, starting 10 years ago, but not getting too close up here, are much better. So that's something that we are surprised to see, but it ties in with what we saw earlier. We repeat this analysis now for quintile number 5, the quintile with the least investment in assets. And as we might expect, we get a kind of inverted result here. And here you can see in green, you get good results if you don't invest recently, and much worse results the longer you look back and you have invested for over here. Remember, this is the portfolio with almost no investment in. So if we pick the best points from these grids that we've got over here for quintile 1 and quintile 5 and replot our performance data here, we get this result over here. So the red line here is looking at asset growth here. This is for portfolio 1, where we've invested a lot of money in assets over here. And this is looking at getting the best result we can for not investing in assets. And you can see we've managed to widen this gap quite a bit over here. Now, what this is also showing us here, and I want you to draw your attention to this green line here, which is actually measuring the gap between the blue and the red line. And we refer to it as a price relative. And the fact that it slopes downwards here pretty consistently throughout the entire period that we're analyzing the data for tells us that this is not a particular event which happened at one point in time during the financial crisis or somewhere else. It in fact is persistent in the data. And that's worrying, because it tells us that actually it's telling us, or it seems to be telling us, that investing is not good. So what we're actually finding then is that in contrast to what we were expecting, the best returns are for investors, at any rate, are for investing in companies which don't invest in assets. And if you invest in companies which are taking on projects, you're going to get bad returns. But it's not quite that simple, because we have to take into account when the investment took place. So just to give you some preliminary conclusions though, it's not a good idea to invest in assets, especially over the most recent 4 years. It is a good idea to let your predecessor do the investment for you. Once the results have not looked good for 3 or 4 years, you take over the company and you're going to show good results thereafter. But this is not really what we would expect or what we want to show. Investors should therefore avoid investing in companies that do CapEx and invest in companies which are showing, in fact, little or no, even negative investment in CapEx. That's worrying. Now, how do we explain this? Well, we've got some thoughts about this, and these are, in fact, in the literature as well. First of all, just to remind you that net present value is in essence simply taking the free cash flows into the future and discounting them back to the present. So on the numerator here, we've got our measure of what we expect cash flow to be, and in the denominator here, we're measuring what the capital costs investors. Now, this results in us perhaps presenting two theories around this. The first we refer to as hubris, which really means that the estimates of the free cash flow are too high. Investors, and this is the people spending the money in companies here, are too optimistic about the free cash flows, and therefore they get NPVs which they shouldn't have got, and they make wrong investment decisions. Connected with that, though, is looking at the denominator here. Perhaps they're optimistic about the cost of capital, which relates to how risky these projects are, and their WACC is coming in too low. And so they're dividing here, if you like, by a low number here, which gives you a high NPV, and so they're not assessing risk properly. And then there's perhaps a third explanation. This is a little more difficult. It simply says that maybe the market's inefficient. Investors are not good at assessing investment, and therefore they're incorrectly assessing the value of companies. So I want to show you a little bit of evidence which perhaps justifies some of these conclusions or these explanations. And I want to put these two together because they are in a way connected. And I want to show you some data from the World Bank. This is the IFC part of the World Bank. And my data is a little dated, but it's the best I got. And what they've done is they have looked at 347 projects that the World Bank has invested in. Now, typically, these are quite big projects, infrastructure type things scattered around the world. Now, they measure the rate of returns in an economic sense. This relates to the whole country, if you like. We're less interested in that as investors. And this is what we're interested in here. How do shareholders do out of this? How do companies make decisions about this stuff here? Financial rates of return. Now, what they do is they do an ex ante and an ex post analysis. This means they analyze the investment before they did it. This is what they thought they were going to get. And then they go back and they look to see what they actually got. And you will see, if we look at all the regions of the world here, that in general, they thought they were going to get a 19% return on this. This is in dollars, by the way. And what they actually got afterwards, when they went back and reassessed what they've got, it was about 12%. But look at Africa. It's the worst of all. They thought they were going to get about a 19% return. They actually only got a 9% return. So this is evidence of either the fact that they overestimated the returns they thought they were going to get, or they underestimated the risk. They didn't discount it enough, and things happened which shouldn't have happened that they didn't anticipate, and therefore they never got the results they were hoping for. Now, the third thing is a little more tricky, simply showing you, though, that it is possible that investors are inefficient, and in a way we know that they are, because we can get this red portfolio here, which is the one which has got the highest investment in assets, to work for us. But we have to do that by looking at the optimal investment here and not investing recently. So perhaps just putting it like this then, companies that invested several years ago, then stopped investing for the last 4 years, might do well. So that's one way of thinking about this. But just to conclude, how should we invest successfully then while still following our intuition that investment is good? Well, it makes sense, as I've just been showing you, to go long in companies that have the highest capex, providing they did it a while ago. So look and see what they did 10 years ago up to 3 years ago. Pick those companies, the best ones. And at the same time, go short, sell companies which have the highest recent capex over the last 4 years. that's going to give you an annualized outperformance of about 8 or 9% based on our historic look back on the data. So it's an interesting topic. I hope you found it interesting. If you've got any comments, we'd love to hear from you by email. Thank you very much.